It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the CFPs on the program. No Kevin Korhorn today again, but with me in the KFG studios, my business partner and sometimes friend, Josh Gregory.
Oh, maybe not at the moment, though, right? Oh, Mike, I love you. Well, listen, 2021 has been off to a roaring start. And in fact, it's been one of the best first 6 months of stock market history when you look at a calendar year, and all of them have come down the pike here. Now, the question is, what does it mean for the second half of the year? What should your expectations be? What's causing all of this? We're going to unpack that for you today on the Wise Money Show.
So Josh, right as I was starting the show and we got things started, he pulled a little joke and screamed into the microphone. And anyway, he's on my naughty list at the moment, so we'll see if I get him back. If you have a question for the program, and we get a lot of questions about, are we in a bubble? We're going to answer that here coming up, and what's going to happen with interest rates, inflation, should I make changes to my investment, all that sort of stuff. If you have questions, reach out to us. If you need some help, you have a second opinion, how do I invest during this unusual time, or I'm looking to retire, should my investment approach change? If you're looking for some one-on-one help, we can certainly help you there as well. So if you have needs or a question for the show, reach out to us. You can do so a couple different ways. Find us online, wisemoneyshow.com. You can call or text 574-222-2000. That's 574-222-2000. And then all over social media, you can reach out to us there as well. Just search The Wise Money Show. All right, so like Josh said, it's been a crazy, kind of unusual year, and we're going to dive into that a little bit. But if you fell asleep right after, did they do a ball drop? I can't remember.
I wasn't awake
on New Year's Day, if you fell asleep and woke up on July 1st, number one, I'd be very jealous because you'd be way more rested than I am right now. And number two, you'd look at the market return and say, oh yeah, pretty great, right? But underneath the surface, it's been very, very strange, and we're going to get into some of that. But let's start by, just what, if you haven't been paying attention, or if you've just been watching the day-to-day movement, what's actually happened the first 6 months in total?
Yeah, I mean, it's been unbelievable. I mean, you talked about it being a crazy year so far, but if you look back 12 months also, or look at what has happened since the stock market hit bottom in March of last year, it's up 92% since then.
That's insane.
It depends on the day, obviously. It can fluctuate, but up almost doubled, essentially, since we hit bottom a year ago. But this calendar year, so the first 6 months of this year, we've already seen the U.S. stock market hit 15.3%. That would be a huge year.
Yeah. I mean, let's be honest, and we don't fall into these little traps where these economists or financial folks make their predictions. Okay, but coming off of such a strange 2020, the fastest drop bear market ever, the best 50 days ever in the stock market, and then all this money printing and the fast recession but recovery, the S&P 500 at the beginning of the year, economists and these other folks, talking heads, were saying, I expect maybe the market could get to 4,200. Guys, by 6 months through, the stock market had well surpassed that. Mm-hmm. The S&P 500 was, I think, 4,350, something like that. And by the midway point. So, Josh, not only would this be considered a good year, it's almost doubled what the average person predicted for this year.
That's exactly right. And, the interesting thing about that, so we're talking about the U.S. stock market right now, but we're really only talking about the 500 largest companies in the U.S. stock market.
Yeah.
If you were to take an X-ray looking into the S&P 500 and actually examine those 500, the top 10 are carrying a lot of that load. That's where a lot of the potential returns or the actual returns that we've been seeing are coming from. And a lot of them are the technology companies. They're the big names that have been high flyers. Not every company is actually higher. But even if we were to look at just the U.S. stock market in its entirety and look at not just large companies, but also small size companies, they also have been booming. Small cap stocks are up 17.5%, so even more.
Yeah, and it's interesting because small caps have got most of that return there in the first couple of months of the year. And then they've gone, in a zigzag, very sharp up, down, up, down, up, down ever since. And that's been very challenging for momentum strategies. We have one and then the other thing that you mentioned, Josh, is, the 500 largest companies, S&P 500, have in aggregate seen this level of growth. But underneath the surface, there's been something unusual happening, and that's what, these geeks like me call it breadth. There's not a lot of breadth right now. And so the stock market recently has been hitting some all-time highs where there's a record low number of companies that are also advancing. Right. A record low. In fact, there's a record amount of companies that are well below their all-time high, even though the stock market is reaching an all-time high. And so for momentum trading and other things, it makes this time unusually frustrating, actually, right, despite this 15% return and for small cap 17% return.
Yeah, and sometimes, again, the financial nerds, they get into discussions about, should I be taking an active approach to my investments or should I take a more passive approach? And they might look at the first 6 months of this year and say, see, if you had just held the S&P 500, you're up 15.3%. Isn't that fantastic? Just hold the whole basket instead of trying to cherry pick the best of them. But the reality is this is an environment where it is not equal. It is not across the board that every company is having the same type of success. And you do have to wonder, well, are some of these companies such high flyers? Yeah. Have they gotten so expensive that they're actually maybe vulnerable to a pullback here? Yeah. And what would that mean for the overall market?
We're going to get into that a little bit more, but let's talk about then if that's the experience of the S&P 500, should your experience match that? Well, no, because in a diversified portfolio, you've got other ingredients as well. So those other ingredients, international, emerging markets, international was up 9%. I mean, still fantastic.
Right.
Fantastic.
That's a great half a year.
Right.
That would have been a great year, even.
Emerging markets up 7%, but then here's the real drag, and it should be no surprise, again, unless, well, hopefully it is a surprise, because hopefully you're not looking at your investments too frequently. But bonds have been, just awful this year because of how interest rates have moved. Now, they've come back a little bit. They're still down a couple percent, though.
Yeah, and that's worth noting, though. Awful is down 1.6% for the first half of the year.
Yeah.
And a lot of folks coming into this year expected there to be kind of a headwind for bond investments because interest rates were so low. And when interest rates start to rise, it pushes down the value of bonds. So you can actually lose some principal or lose some of your account balance because of these interest rate changes. Yeah. So even in a really crummy environment or even in a headwind scenario, being down 1.6% is not terrible until you start comparing it to what the stock market's been doing.
Yeah, and so on average, it just depends what your mix is, but should you expect to look at your statement be up 15%? No, you shouldn't, and especially if you are holding 40% in bonds or 30% in bonds or 50% in bonds, then it's going to be significantly different than that. The question really then is what's driving these returns, and as Josh and I have already alluded to, is the peculiarities that are going on right now. Are there some threats brewing underneath the surface? Are there reason to be concerned with some of these? And frankly, I think so. We're going to get into that, what's driving the market and what could be ahead. That and more coming up on the Wise Money Show with Korhorn Financial Group. YouTube, I need to wake up. Welcome.
Do you want me to help you with that again?
Josh screamed right as I'm starting the show. My ears are still ringing. So thanks for being here, YouTube. This is the Wise Money Show. You are at the Wise Money Show channel. Hit that subscribe button. Turn on notifications. Smash the thumbs up button if you like the content. What you're watching right now is our weekly 1-hour talk show airs right here on this channel, 10 a.m. Eastern Time, also on podcast, 10 a.m. Eastern Time. It's a full hour. Yep, it's a full hour. Airs also on a couple radio stations here locally in northern Indiana where we're from. If that's too long, you're looking for something more palatable, something more bite-sized chunks, all throughout the week we have Next Wise Step videos, taking one financial concept, applying it directly to your financial life. So if that sounds like it's something you're into, hit that subscribe button, turn on notifications, and then smash that thumbs up button. Lindsay, what you looking for?
I just noticed this extra microphone is missing.
It's up in my office.
I wondered if you had it. Sorry,
I was afraid you were going to say like the audio is not being captured or something. That would have made me start weeping. I'll just confess that to you.
I would have just been done.
Or that when I screamed in the mic, maybe I broke something. I was worried about that too. All right, so no crisis back there?
No, we're good.
Okay.
Yeah, when you start looking around, I'm thinking either there's a critter on the floor or yeah. All right, let's get into it. So trouble brewing beneath the surface of what has been just a phenomenal experience by the S&P 500 in the first 6 months. Is there trouble brewing? There could be, guys, and we're going to talk a little bit about that. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios. No Kevin Korhorn, but Josh Gregory is with me. If you have any questions or to stay up to date on Wise Money content, go to wisemoneyshow.com. Stay up to date there and then submit questions there. And then all over social media, wherever you're at, we are there as well. Submit questions there and subscribe to it. Just look up Wise Money Show. Okay, so market has just been, it's just been peculiar. It's been, like a tornado is coming. And you know, because you've watched and you've seen on your weather app, okay, we got some bad weather and it's just weirdly calm.
Yeah.
That's sort of, you could feel that right now because we know there's all sorts of risk out there, and yet the market has just sort of shrugged it off. Why? What's been driving the market?
That's a good analogy that you're using, and hopefully it doesn't mean that there's a storm coming.
Yeah.
But the strangeness of the calm, I guess, is noteworthy, though, isn't it? Because it's not like it's all good news all the time in the economy and in the stock market, but it's sometimes kind of telling when you hear the news and you watch investors globally, their reaction to it. What are they spooked by? What are they encouraged by? That kind of thing. And there have been plenty of themes that have been happening over the past year. You don't have to go back in time too far when all of the headlines, it felt like, had to do with the coronavirus and are we going to get vaccines and blah, blah, blah. And really the market's reaction was just, is there any positive news? Is there any hopefulness that this thing's going to get behind us at some point? Mm-hmm. I noticed the other day, I don't get those articles pumped into my newsfeed anymore. Mm. Isn't that interesting?
Yeah.
Some people might have a political statement attached to that, right? But the reality is it's not as much the focus anymore.
Right.
And I think people are kind of shrugging it off, trying to get back to normal. And that has been often what's been driving the stock market here recently. It's the hope that we are going to get back to normal. Mm-hmm. Sometimes it's referred to as sort of a reopening trade or buying the companies that are going to benefit when we can finally get back to normal. Because those are often the companies that were struggling through the pandemic and the shutdown and everything. Mm-hmm. Are things going to return to normal? Things like travel-related industry or restaurants, and certainly, some of the entertainment industry like theaters and right. Things like that. That's gotten a lot of publicity here recently.
Now, so let's dive into that. Return to normal. We're certainly going to talk about these meme stocks. Okay, so AMC and all that company it's lost money every year for the past 5, I think, maybe even longer. And so this isn't a pandemic problem.
Right.
And yet it went from a $3 billion valuation to $30 billion because of all this pumping and energy, not optimism, but just energy into this. And yet, I don't know the individual's name, but I did see a headline yesterday that someone who's run 2 different movie studios said, listen, the movie business is dead. It's just dead. And it's not because of the pandemic, although that accelerated things. It's because of streaming and so on. And these Amazons and Netflix, they're making movies not for the art of movie making, but just to grab subscribers. And so they're using algorithms to basically just try to grab your attention for 100 minutes and then move on. And they're not pumping them up. They're not doing that. So, and this is someone who's passionate about the movie industry and is reflecting that it's never coming back. Yeah. And so there could be some permanent change. The other thing I would say is, so what's back to normal? Corporate profits are back to normal. If you look at the trajectory of corporate profits and their growth, and then you've got the pandemic, wham, way down, and then you've got where we are now and then what's expected, it's right back on the same plane.
Yeah, it's as if 2020 didn't even happen, right? Yeah. And the forecast of it continuing on into the future also assumes the trend continues.
What's not back to normal? The Federal Reserve is still pumping $120 billion a month into the system, which, if you're counting, that's almost double what they did even during the Great Recession, right? So they are the economy. While you would say, well, geez, corporate profits are back up, and we also have a record number of job openings right now, and yet the economy isn't even on life support. The economy is like, what's the next thing above life support? Like, it is still has so much money being injected to it, and it's so accommodated right now. To me, I think that is the number one theme.
Yeah.
That we've got this reopening happening, and we've got government spending out the wazoo. But in addition to that, the Federal Reserve is keeping interest rates at its lowest rate, ever, and has promised to do so for a while, and then continues to inject liquidity into the economy.
Yeah, there's not that many economic topics that make their way into history books, but it sure seems like someday this one would be worth writing about, because in the year 2020, like we've never seen before, you had Congress and the Fed, our central bank, acting in concert together, kind of in tandem, and pouring it on like we've never seen before. And it was out of fear of, well, we haven't ever seen this scenario before. We've never shut down an economy before. And so the amount of money that the government was borrowing and just kind of just pouring it out onto our nation, onto the economy, that, and then the breathtaking amount of printing of money and the stimulus that the Fed is doing. Often one of them will be working hard, the other one isn't doing anything. But a crisis brought about a commonality and a common focus, and it worked, right? It has had an economic impact for sure. Now, is it lasting? Is it too much? Nobody knows. And a lot of people wonder, well, is this going to create inflation? And inflation is another one of those themes that have been on most investors' minds. Certainly a question we get all the time when we're meeting with clients.
Yeah. And so is it sustainable? Right now we've got government debt that has ticked over $28 trillion. And
you said that so nonchalantly.
I know. Well,
it's just $1 trillion.
It's no big deal. I'm just kidding. It's an enormous deal.
Yeah, you can't even get your mind wrapped around how big $1 trillion is, and we've got 28 of them on our credit card balance right now.
On the way to 30, because the budget, the budget, which apparently includes some tax increases that haven't come yet and likely are not going to come, at least the latest rumor.
You mean they're spending it before they've got it?
Is $6 trillion, and the tax revenue is only going to be around $3 trillion. This is our biggest deficit we'll ever have. And so on autopilot, which those forecasts are always optimistic, way too optimistic, we'll get to over $30 trillion this year in debt. And on top of that, so that's what you're talking about. We've had this ballooning debt from government spending, but then the Federal Reserve balance sheet, meaning how much money have they printed and basically used to purchase investments, purchase securities, dumping money into the economy, was just below $1 trillion and stayed that way for a long time. And then 2008 happened, and get this, they printed $1 trillion. So it went from $1 trillion to $2 trillion. And then it was steadily going up to $4 trillion. And then whammo, we've gone from 4 to over 8 trillion. And they're still going. They're still going. And so
if you're trying to make me mad, it is working. So if this is the payback for me making you mad earlier, keep it up. This is awesome.
It's not. This is. When you add up all that debt and all of the injection of cash and compare it to what all of that has then created an economic output, the stock market is at its same level as it was 20 years ago. When you take that money printing out of the equation, take it out of the market, it's pretty much flat. And so it hasn't gotten us the advance. So we're going to break down more what's ahead in the stock market, that and more coming up on the Wise Money Show with Korhorn Financial Group. Yeah, so we're not going to do this right now, YouTube. I'll do a video on it coming up. But basically, you've got the stock market and how it's gone over, I think, since 2005 or probably since 2000, if it's 20 years, how it's gone. And then as the Fed has dumped money in, there's a chart that basically takes that then out of the economy, like out of the stock market, because that's sort of falsifying the true growth of the markets in a way. Well, you've just added liquidity, so of course things are higher. And Josh just giving me that look.
So do people? No, I'm just trying to get my mind wrapped around it. Do people point to a chart like that and say, "See, this is why we need the Fed to bail us out"? Or
no,
are they saying it's all funny money?
It's all funny money. This is a false economy that we're in. That's what people are saying. Normally I don't even save those. I've seen it enough, so I'm not seeing it in my research here.
You don't remember what the source was?
No, because it's been multiple. I've seen it. Next time I get it, I'll shoot it over to you. Because I'm. Just another couple swipes here. Let me see. So basically it takes this chart here and injects it into the S&P 500 performance, and it almost is an inverse of that, where these steps ups are step down. And yeah, dude, there it is. No, S&P. Yeah, that's not the one I was thinking of, but it's like that.
So if you remove the Fed's action, this is what the stock market on its own would have done?
Correct. If you just dollar for dollar, basically. That's not exactly the chart, that's the ratio, but yeah. That's an economist in Germany. So
that's interesting, because I actually was wondering something similar, that surely someone's done this study. If you look at all the stimulus money that's been dumped out into the economy, could you quantify how much of that has made its way into the stock market?
Right.
And how much of it is still sitting in bank accounts? And then what portion is actually stimulating the economy and, driving some sort of upward spiral? Because those are very different outcomes, right? I mean, if it goes into the stock market, that's not stimulating the economy at all. It's just boosting the stock market's price.
Right.
It has no tangible effect unless people start cashing in their investments and spending it. But
all right,
I'm gonna research that. I want to figure that out.
Yeah.
You got my nerdy juices flowing here.
There you go. Are we in a bubble? I mean, that's sort of the question when you look at the market, when you look at that, the housing prices, all that. I mean, can't talk about an update on where the stock market is without asking that question. We're going to answer it right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Across from me in the KFG studios, Josh Gregory. No Kevin Korhorn today. We miss him. He'll be back soon. All right. If you want to stay up to date on all Wise Money content, go to the YouTube channel. Go to YouTube, search Wise Money Show. Follow us there. Get this episode, all our others, and Next Wise Step videos, other content that we post there on a regular basis. So go to YouTube, search the Wise Money Show. Follow us there. All right. We've recapped what's happened in the market in the first half of the year and talked about what's been driving it. Normally, when we do these halftime reports or even a year-end review, what's been driving it, and we're listing out several factors. And that's Fed. It's Fed. I mean, we hit two. That's what's driving it. The economy's reopened, so profits are back, and the Fed and government are just printing money and spending money like crazy. And that's it. That's all the summary you need. So then the question is, when you've got that trifecta, meaning the economy's back open and corporate profits are back on their pre-pandemic levels and growing, but you also have the bazooka, right? Didn't Jerome Powell say he's got a bazooka, an economic bazooka that he'll be shooting into the economy? When you've got the bazooka and all the weaponry of the Fed pumping money and expanding liquidity in their balance sheet, and you've got the government willing to spend your grandkids' money until it's laughable levels. You've got all this money pumping in. It's not sustainable, right? So does that mean we are in a bubble?
Well, to me, that's not what makes it a bubble. Unsustainable doesn't mean that it's going to suddenly burst. It just means that things are going to change at some point. Because if something can't keep going on forever, it won't, right? And they can't keep on printing money forever. The government can't keep on borrowing money forever and just dumping it out there. At some point, this economy has to stand on its own 2 feet without being on life support, as we often say. And many people would say, well, we don't need it right now. Mm-hmm. So why are we doing it? And at some level, the Fed has kind of tipped its hand and has confessed publicly that, well, we want there to be a certain amount of inflation that's created. And we're not going to be satisfied until we have created some of that inflation. And you could get into all kinds of political reasons for why they would want that, but it is a clear change from what their normal mandate has been for our entire lifetimes, right? I mean, we were born into a high interest rate environment because of inflation. It was like public enemy number one. Right. And now we're kind of drifting back the other direction saying, well, maybe actually it would be a little bit good to have some inflation going.
Stable prices and what maximum employment.
Yeah, right.
Those are the mandates, and yet now we're talking climate change, and now we're saying we want to drive prices up.
And isn't it ironic, though, also that some of the government action recently here has created incentives for people to not get back into the workforce? Yeah. It has been more profitable to not be working for many people. Mm-hmm. And this has created quite a disruption. I mean, we still have supply chain issues in this country because there's just not enough workers, right? To unload docks at some of the key ports and some of the shipping and everything. There's just not enough people to get the job done. And it's creating some genuine hardships in certain manufacturing settings.
That would be a point of hope or optimism that this bubble, this quick rise in the market and the economy doesn't burst. It does seem like there's greater demand than we even have supply to meet it. And maybe as that supply comes back online, the demand won't have this big shock to it where all of a sudden it drops. It will be more tapered. And that that could be a benefit.
One of the places where I would say that exact same thing is in the housing world. Like we are short a whole bunch of houses in this country, millions of houses, because we were behind the 8 ball coming into this thing. You have all this disruption of a shutdown. And now you also have a shortage of people in the construction industry. There's not enough houses being built to satisfy the needs of a growing population right now. And so I look at that with an optimistic eye, that for the foreseeable future, there may have to be some more aggressive building happening just to meet the demand, as you were saying. Yeah. Now, we certainly hope that prices can kind of stabilize and things like lumber don't keep pushing the price of those new houses so sky high. Mm-hmm. But I don't know, like you think about in a normal economy, what are the good things that help drive economic activity? build a house.
Right.
Because it's not just build the house and all the jobs that are created there. It's all the other stuff that goes into the house. It's the carpet, it's the appliances, it's the furniture, the paint, all the things that go into a house. It has this kind of ripple effect in the economy, and it's stimulative, right?
Speaking of, the Bernards went and made a purchase months ago, replaced some furniture. So the kids are still, they're still a little messy, but they're older. And so we get to yell at them when they make messes. And just kidding. So the furniture that has all the stains on it, 10 years old or something, we said, let's get some new furniture. 6 months. 6 months. We was even paid for
That's
it.
how long you had to wait to receive it?
Yeah.
Wow.
We got it right at the beginning of spring. And Thanksgiving. You'll probably have it by Thanksgiving. My
Wow.
goodness. So I would tell you then, hopefully we're not in a bubble type situation. And yet I would also tell you there's no doubt, there's no way to slice it. The market is expensive. Now, does that mean, what goes up has to come down? I wouldn't necessarily say that. I wouldn't. It's not like gravity where you throw something up in the air and you know exactly it's going to drop, it's going to drop here, and it's going to drop, immediately.
Right.
That's not the case. But so how would you say the market's expensive? Because it's at an all-time high? No. That's how it's supposed to work.
That's right.
That's how it's supposed to work. And because Josh shared the analogy before, it's sort of like watching someone bouncing a yo-yo, and the market's, the trajectory of the market and the movement is the yo-yo, but that person bouncing the yo-yo is walking uphill or walking upstairs. That's how it works. But when you look at the price per share for the earnings, and we've got record earnings now coming back online, the price of a share of stock per earnings is now at higher levels.
Yeah. You're talking about the PE ratio.
The PE ratio.
Have you been talking about that with clients at all?
Yeah. Yeah.
I think if Kevin were here, he'd be throwing things at us because we're getting awfully nerdy here. But I've been talking about that a lot because if you look at the PE ratio as a measure of how expensive the stock market is as a whole, it's reaching levels that are similar to the late 90s, early 2000 range when we were in college, essentially.
Yeah.
And that period of time, we look back on the stock market and we've labeled it now, right? We call it the .com what?
Yeah, bubble.
Bubble.
The tech
.com bubble.
Mm-hmm.
And that doesn't necessarily mean that we're in a bubble right now, but it certainly should make us cautious and being extra watchful for bubble-like tendencies.
And even then, it's not like, once it hit this high PE, it just dropped. No, it kind of hung out up there for 6 years.
Long time.
And then the other measure that you would say, well, listen, I don't care your opinion on bubble or not. The market's expensive right now, is Warren Buffett has said in the past. Now he's since sort of changed his tone, but the best indicator of the market's valuation is to compare the entire market cap to GDP. And that's termed the Buffett indicator. It's record level. I mean, the market is 200% of GDP. It's crazy.
So if you looked at the total value of all of corporate America, compare it to the size of our economy, it's twice as big, you're saying.
And it's record levels. So, okay, if the market's high and if we've got all sorts of intervention happening, what changes should you make? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Right, that second segment? Dude, I'm telling you, like, my brain is...
second?
Yeah. We're going to have to take a little intermission at some point. All right, so what's going to drive the markets, and then what should you do with your investments right now? We can talk about our philosophy. We can talk about rebalancing. We can talk about whatever. All right. I did have some static in my ear at one point.
Did you really?
Yeah, it was just like a blip, and I looked at you, and you were just talking like normal.
Hopefully that means the headphones are broken and not your ear.
Yeah. All right, here we go. With where things are in the market, should you be making changes with your investments and your investment strategy? That's what we're helping you with right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard, here with me in the KFG studios. Josh Gregory. Kevin is on vacation. If you've missed anything, every episode of the Wise Money Show is on podcast. Go check it out wherever you listen to podcasts. Search Wise Money Show and follow us or subscribe to us, whatever the platform is there. And then also rate the show. We appreciate that and appreciate your feedback. So, okay, so we talked about where the market has been. We've talked about why. We've talked about, is this even a bubble? What should we expect the rest of the year? What's going to drive the markets? And what then adjustments should you be making?
Well, so in the last segment, we left off kind of talking about PE ratios, which is it's a measure of how expensive the stock market is. But what's it comparing? A PE ratio is looking at the price you pay for a stock compared to the profits of that company. And a lot of people they'll pay extra to own a company that they really believe is going to grow quickly and become more and more and more profitable in the future. And so if investors as a whole are right now willing to pay or have been paying a lot higher price for the stock market, it implies that they're hopeful that corporate America is really going to start cranking some serious profits. And so I feel like that's what we've got to be watching for here and hopeful that actually transpires, that these profits really do start hitting the bottom line of companies. You start having some surprises there, and the market gets a wake up that, oh, maybe I paid too much for this company. That's when you start seeing some selling pressure happen.
I completely agree. And yeah, the Fed and spending and that sort of stuff will drive things. But I think the I word is going to be the biggest driver these last 6 months, and that's inflation. Because, Josh, you're absolutely right. It ultimately comes down to earnings. And yes, sometimes the market pays a lot for earnings. Sometimes it pays less for earnings. But it's really earnings is what matters. Now, what goes into earnings? Well, if a company is increasing their prices, that means their revenue goes up and their earnings could go up. But if their costs are going up at the same time, or if their costs go up before their prices go up, then that means their earnings go down. Right now, we are in a very, very strange spot with inflation. You've had goods and services increase in cost. We've got labor pressures. Why? Because we're actually seeing wage growth. No, without speculating, I'll just tell you there's a record number of jobs open. McDonald's, I think, is even paying someone a signing bonus. What is this? The NBA? like seriously, you get some money just for showing up to work your first day. They're just gonna give you a bonus. That's crazy. And that's just basic economics. That's not something interesting in the secret sauce. That's basic economics, supply and demand.
That's right.
If we've got tons of supply, lots of openings, and demand is low, people applying for jobs, they're going to increase wages. And that's going to increase costs for companies, potentially pushing down their earnings. If then a company then starts increasing the price of their goods and services, or the price of their product, but they increase it too quickly, and all of a sudden customers start leaving. So we are in this very, very weird dance. And to make things more interesting, as a consumer, you don't need me to tell you prices have been going up. They have. You see it. I see it. And yet we now have this narrative, and it was even found out that they're going to be leaking this narrative out, the Fed, that inflation's not going to be a big deal. And so we've seen this, and we've seen even interest rates and the bond market respond that, nope, inflation's not going to be a big deal.
Right. The word they use is transitory.
Transitory.
Right? It's going to disappear before your very eyes. It's only here temporarily.
So even in the last month, inflation expectations have dropped very, very quickly, and we can't tell if that's honest or not. Mm-hmm. There's no doubt manipulation. Well, you could say, well, the market is rarely wrong. The market's almost never wrong, you could say. So one of the most famous investors ever says the market's never wrong. And yet, when you've got the Federal Reserve buying and selling investments in the market to manipulate the market, how can you say it's right?
Yeah.
Right? I mean, if you're saying interest rates have changed because inflation expectations have come down, but the Fed is a major player in in making a market for those securities, how can you even trust it?
That's right. I mean, it's not predictable, essentially, right? Who knows what Congress is going to do next? Who knows what the Fed is going to do next? And those that say that that the markets are always right, they're kind of implying the market is such a fast reactor to this type of news that it will quickly, when it realizes what the Fed is doing, it will quickly change its price, change its tune, change its posture and everything, and get right fast.
Yeah.
But it doesn't mean that the markets on a whole are always accurate in their prediction of where things are going, as evidenced by the extremes that sometimes we get into. Mm-hmm. Sometimes the stock market gets oversold and it's priced down to levels that don't make sense anymore. Sometimes it's overbought and it gets pushed up to prices that don't make sense anymore. The good news is, although a painful good news, is it's self-correcting, right?
Yeah.
These things have their way of working their way out. A lot of investors then, they fear that self-correcting behavior of the market. They fear, well, what happens if my investments go down in value?
Right.
I need to do something to make sure that never happens. And that's the wrong story problem to be solving. It's not, hey, do I have the ability to see around corners and to predict what's going next in the market, and therefore I'm going to get out ahead of this. I'm going to make all the right moves and never see my account balances fluctuate. No, they are going to fluctuate. And recognizing that risk is present always in your portfolio is one of the most important things that you have to learn as an investor, because it helps you manage the risk at that point and recognize what are the things within your control, what are the things that are outside of your control, and maybe more importantly, which ones are the things that actually matter. Mm-hmm. You know, this whole show we've been talking about the investment world and what it's doing next and what's been driving it and all that. That's just so that you can be aware of what's happening around you, understand why your investments have done so well here recently. But we would be doing you a disservice if we didn't at least pause and say, why does all that investment mumbo jumbo even matter? Because your investments are the funding mechanism for your most important goals in life, your long-term goals like retirement and sending your kids to college. And so investing is part of your overall financial plan, and you need to keep on improving your own education in this area so that you can make wise choices for your financial plan.
That's right. All right, so let's take some action items really quick. Josh just did his monologue. I've got mine. So I'd rebalance right now. We do that here for our portfolios every 6 months. I'd rebalance. If the stock market is way up and the bond market's down, capture some of those gains a little bit and be mindful of that. So I'd rebalance is number one. Number two, I would tune into where you stand with your financial goals. Met with some folks yesterday. He said, hey, I'm retiring in 6 months. I've already done the work. I know that I'll be able to do that. Okay, have you updated your investment portfolio to match this time horizon? And he looked at me like I was crazy, and then the light bulb went off like, oh my goodness, I'm taking a lot of risk for this big change. So make sure your investments are in alignment with your big picture financial goals. And then third, make sure you are diversifying your strategies, not just your investments. Momentum investing has been very challenging over the past 6 months, or really the past 3 months, which is the complete opposite of the way it's been over the past 24 months. But make sure you're diversifying your investment strategies so that you've got diversification. The point is, they're not all going to move in the same direction at the same time, but that manages risk better, helps you achieve mathematically higher returns over the long term with lower drawdowns and lower risk. So make sure you've got a momentum strategy and a core diversified strategy as well. All right, we've got more on that, as well as questions from fans of the show. That and more coming up on the Wise Money Show with Korhorn Financial Group.
Fourth segment. Listener questions.
Yeah, unless there's anything else, I thought we'd open with, okay, any other action items on market and any other final thoughts on the market, and then we can get into it. I haven't looked at the questions. Is there one you want me to start with?
No.
Okay, we'll then start with Bill, Kathleen. We'll just kind of move on down the line. So... When's the right time to draw Social Security? That is sort of an evergreen question. We get that a lot. That's what Bill reached out and asked. We're going to answer that here in just a moment. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Across from me in the KFG studios, Josh Gregory. Kevin Korhorn is off today. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media. Just search the Wise Money Show and follow us there. This has been our halftime report for the markets. Now, your financial life is made up of 6 different areas. Investment planning is one of them, okay? It's not all of them, right? So investment planning should get a lot of attention, but it should also be connected to tax planning and your cash flow, present financial position. What the reason you're investing, which is typically long-term goals like retirement and college planning, protection planning. This is your investments are mixed with 5 other areas in your financial life that all need attention, and you need to make decisions that bring alignment with all of those. Now, that said, we talk about investments from time to time, but at least twice a year, once right around the beginning of the year, once right around the middle of the year, we do a show devoted to what's going on in the investment sphere and the investment universe. Josh, any final thoughts or action items with the investments before we jump into questions?
Maybe just a reiteration of something that you already alluded to, and that is no matter who you are and what you're investing for right now, whatever goal is attached to the investments that you're managing and making decisions on, I think it's important to pause periodically and make sure that you are taking the right level of risk. When the market has been running as strong as it is, there's almost always going to be some sort of a pullback along the way. In fact, what's the statistic? It'd be interesting to look this up. What percentage of years, calendar years, have at least a 10% drop of some sort at one point or another during that year?
One of my favorite charts, and if Kevin was here, he would say his favorite chart, although sometimes it's mind-boggling to him, the average inter-year drop. So from a high point in the year to a low point in the year, the average drop is 14%.
Isn't that amazing?
This year, it's only been 2, I think, 3, something like that. So you would say, based on averages, I mean, I'm wondering the folks that are listening to this saying, wait, you haven't made your prediction yet. You haven't made your projection. Guys, you're at the wrong channel. That's not
right.
That, like, the folks that do that, no one stinking knows. And here's, I haven't said this in a while. If you're like, yeah, but that's entertaining to me, and I think they're right. In 2020, did anyone predict a pandemic?
Right.
Did anyone forecast, you know what? It's January 2020. I think we're going to have a global pandemic and everything's going to crash and then everything's going to boom. No one predicted that. So it's just foolishness. So we're talking about principles, big picture principles. That's what we do here. That's what your financial decisions and investments should be based on.
And that's, I don't know if this is a principle or if it's just a reality of history and therefore probably a worthwhile reality of the future to hold on to. It is common for the investment world to have these types of pullbacks. You just said 14% average pullback when one occurs in a calendar year. It's most years that there's some sort of we call those corrections. If the stock market's down 10% or more, it happens so regularly. And to me, it's making sure that you are emotionally and financially ready for some sort of a correction. It doesn't mean the world is ending. It doesn't mean that the bubble has burst. It doesn't mean that your financial future is unraveling before your eyes. It's just what the stock market does. Mm-hmm. And so to me, when you've had this strong of a run-up, a lot of people's portfolios, they start to become naturally more aggressive than what they really intend. And that's just simply because the stock market portion of your portfolio has ballooned to a bigger size. So you may need to go back and take some corrective action, kind of rebalance things back to an appropriate mix of investments for your financial plan. All roads point back to the financial plan when you're making your investment decisions.
In the last 41 years, 31 of those years have been positive years in the market, and yet on average, there's been a drop of 14% within the year. In the 80s, there was just one negative year. That's it. In the 90s, there were 2 negative years. In the 2000s, of course, there were several. There was 4. But from 2010 to 2020, there's 1.
Yeah.
One negative year.
And that's because a lot of times these corrections, they solve themselves or they rebound faster than what you ever imagined they will. I mean, look at last year. That was not a negative year in the stock market. The year 2020 was not negative, but it was very negative for a little while.
It had a 34% drop in it, and yet it was positive 16% for the year.
Right.
So, yep.
So prepare yourself for volatility because it is always there. It is ever present in the market. And that doesn't mean you're doing something wrong just because you see your account balances fluctuate from time to time.
All right, let's transition here. We got Bill. He reached out with a question. I was planning on drawing my Social Security as soon as I retire at age 68. My benefit will be $3,450. My wife is 65, and her benefit is $950. Do you think I should draw immediately, and how much will my wife receive?
So this is exactly the right type of question to be asking as you're marching into retirement. One of the biggest financial decisions that you make is, when do you draw Social Security? And of course, we would look at this question and we'd have to say it's not knowable what the right answer is based on the information that we have here. It's not knowable, for example, if you were to delay Social Security, what are you going to live off of in the meantime? If you've walked away from a paycheck, you're not yet collecting Social Security, you have to have other resources to bridge that gap while you're allowing your Social Security to keep on appreciating. But that fact alone, a lot of people don't give enough credit to, or they don't emphasize the benefits of waiting to draw your Social Security. It is an 8% increase.
Yeah.
If every year that you delay your Social Security, you're getting an 8% reward for the rest of your life, potentially for the rest of your surviving spouse's life, if you're the larger drawer out of Social Security there. So to me, I would frame this story problem as, first of all, it's a financial planning question, not just a retirement income question. There's tax implications here. This has implications on your investment portfolio. Do you have assets positioned in a way where you can draw off of them easily without too much risk of fluctuation while you're waiting for the Social Security to continue to appreciate? But if you can pull it off, and not a lot of people can, a lot of people, the day they walk away from a paycheck, they need Social Security coming immediately, right? Because they hadn't done the kind of planning. The fact, Bill, that you're even asking kind of implies, though, that you have an option at your disposal here. And to me, the way to answer this question is by running a retirement forecast to say which one's going to give you the best shot at the right outcomes for your whole retirement.
Now, what's interesting, he did include here his wife's age and her amount. In fact, when I connected with Bill following this question, there was more confusion around, well, how does my wife's benefit connect with mine? How does that really work? And while Josh is right, I mean, this is a financial planning question, of course, but while Josh is right that there's great benefits, 8% growth on your Social Security if you delay, in this scenario, if you're 68, your spouse is 65, and your benefit is $3,450, but hers would only be $950. She's going to get half of yours, and then minus a
haircut if she takes it early.
Yeah, but she can't do that unless you start drawing yours.
Right.
You used to be able to. They closed that loophole. And so if he delays, that means she needs to delay, or her benefit will be lower, depending on when she draws. And so it's not just one benefit you're looking at.
That's right.
You've got to look at both. And so the right answer is embedded there within that comprehensive financial plan. But just be aware, if you've got, basically, you're going to be able to draw your own Social Security or half of your spouse's, whichever is higher. Okay? So if you and your spouse have very similar Social Security, then that's going to weigh in on when you should take it. That's going to be a factor. If not, if they're very different, like Bill's, then you've got to consider both of you in that timing. So work with your CFP on it.
That's a good point, because there are some times when it is not to your economic benefit to delay Social Security, right? It could have to do with your own life expectancy. If there's a major gap between the two spouses' ages, that can have a bearing on it. Again, your own readiness and your ability to even pull it off. Do you have the resources to do it? That's unique to your situation and different from your neighbors. And so to me, one of the biggest morals of the story when it comes to making a Social Security decision, don't just look at what your neighbors did.
Yeah.
Don't just listen to your brother-in-law at a backyard barbecue and take his advice as if his situation applies to yours. Because first of all, you don't know what kind of analysis he did. He may just have a bias towards take it as early as you can. You got to get your money and run. That philosophy is just pervasive out there. That doesn't mean it's the one that's going to maximize or optimize your own retirement outlook. So work with your certified financial planner to answer this question.
I don't know if we even have enough time to answer Kathleen's question here. She reached out and said, my husband and I were investing in our 401ks at work. We've got a broker that invests our IRA, and we have a CPA that does our taxes. Of course, we've got our insurance with the company as well. Why would we need a CFP?
You don't, probably.
Yeah,
I'm kidding. No, yeah. Why would you need a CFP? I mean, have you had this question when someone has their team in place? To me, one example, I've literally, I have a client, just met with him yesterday, who is a CFP. Mm-hmm. And brilliant guy. I mean, he knows the strategies, he knows the rules, he knows all the techniques, all the process inside and out. And for him, and he said this on the way out the door, he said, Joshua, the whole reason that we're here is because someday if I pass away, my wife hates finances. She doesn't know any of this. And I want to make sure that she has someone that she can trust long into the future. Mm-hmm. And, to me, it's about continuity over time, and then also continuity amongst the perspectives of all these professionals. How do you bring it all together so that they're truly collaborative professionals all working on the same plan together, instead of each of them having their own perspective, their own opinion, and maybe taking you in very different directions?
You guys probably want to invest as much as you can in your 401k. Your broker wants you to invest more into your IRA or invest it a certain way. Your CPA doesn't care how much you contribute into your retirement, and your insurance professional wants you to buy as much insurance as possible. That's why they each of these areas have their own agenda, and you need someone tying all the agendas together into one plan. That's the role of your certified financial planner. Great question, Kathleen. We'll get into more of it in the future as well. But that's all the time we have for today. On behalf of Josh Gregory and all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.